afternoon. Welcome to NDTV Profit. We are here at the India Investor Summit organized by JPMorgan in Mumbai. And I have with me Mr. Jahangir Aziz, the Head of Emerging Markets Economics Research and Commodities at JPMorgan. Jahangir, welcome to this conversation. Let me just quickly set the ball rolling. You have two large central banks across the world cutting rates. China last evening announcing that they are also joining the game.
Right.
What does this mean for emerging market economics, Jen?
So I think there was a lot of skepticism whether or not the Fed would cut rates, and we had a 50 basis points of rate cut back, 2 months back, when the July non-farm payroll came in, and I think at that point in time we changed our view on emerging Asia and Asian central banks' rate cutting cycle. So if you look at the way in which the emerging market world had been divided, you had the European central banks as well as the Latin American central banks who had taken rates to significantly higher than where the Fed was. So they could afford to cut rates even if the Fed was on hold. And that's what Brazil and Mexico and Hungary and Poland, etc. did. Asian central banks never took rates up that high. They had barely 200 basis points of gap with the Fed, and that's because inflation wasn't that scary in the region. But it also meant that they couldn't cut rates even if their domestic conditions required, because afraid that the FX would start depreciating if the interest differential went down. I think the 50 basis points of rate cut and the fact that market is now firmly convinced that this rate cutting cycle will continue at least for the first 150 basis points before any kind of reassessment opens up a significant space for all Asian central banks, barring Japan, to start cutting rates. I think you saw Indonesia starting that off with the day before the rate cut. Yesterday you saw the PBOC both cutting rates as well as reducing the reserve requirement. And I think broadly, the rate cutting cycle in Asia has begun. It will continue. It is obviously not going to be large because the rate hikes in the first place weren't very large.
Yeah. The Indian Central Bank has repeatedly talked about how we are not being driven or not being guided by what's happening in other large economies. We are so focused on our own domestic issues, we don't want to think about a rate cut right now. But how far can they take it?
Look, the RBI has always said, this is not this administration, the previous administration, and everybody, as far as I know, have always said that we don't follow the Fed. I mean, that's, they have to say it, they say it, right? They may not follow the Fed, but they obviously react to what the impact of the Fed is on global financial conditions and how that transmits into India, both in terms of interbank rates as well as on the FX. So saying that we don't follow the biggest central bank, if you have to say it, you say it. My guess is that the domestic conditions in India for a significant period of time required rates to come down. I know that's not the market consensus. And the reason why it has to come down has to do with the fact that core inflation in India, which we don't pay too much attention to it, but the RBI does. The core inflation in India right now is at its lowest level since the index started, which was back in 2012. Not only is it at its lowest level, it has been falling at a sustained level for the last 9 months. A large portion of that, if you want to, you can attribute that to the disinflation brought on by Chinese export prices, right? But even if the Chinese presence is very large in some places like steel, etc., it cannot be the only explanatory factor driving domestic core inflation, doctors' fees and tuition fees, etc. down. That basically says that whether you're looking at recorded growth or not, or high-frequency activity data, etc., you can throw all of those at me, but it basically means that not only does this economy have excess capacity, it has significant excess capacity, and that excess capacity is not narrowing, it's widening. The proof of the pudding of excess capacity has always been on core inflation. This is core inflation at its lowest. and has been falling on a sustained basis for the last 9 months.
Okay.
You can throw at me any activity data, and I will go back to you and say the proof of the pudding is core inflation.
So is there a pricing power issue then with the manufacturers?
Well, why isn't there a power? Why can't manufacturers price? Because there's no demand. Why isn't there no demand? Because real incomes are weak. Why is real incomes are weak? Because there's excess capacity in the economy.
What do you make of this debate between core inflation versus food inflation, where we have to pay attention to it? You can't just let it be.
Absolutely. I'm not saying that you don't pay attention to headline inflation. Look, all emerging market central banks, the driving force of their decision is headline inflation, because that's what drives inflationary expectations in the economy. I'm not saying that. I'm saying that look at core inflation, not because you need to cut rates because of core inflation. The core inflation is telling you something about what is happening to the state of the economy.
Right.
The core inflation telling you that the state of the economy, there is significant amount of excess capacity, and that the excess capacity is widening, and therefore, just like the Fed, they will have to recalibrate their interest rate positions. And I'm not saying that they need to turn completely accommodative. They need to recalibrate from the restrictive stance to more neutral stance.
Okay. You mentioned about Chinese presence and in certain spaces, like for example steel. Considering that they are in an expansionary or sort of that's the kind of mindset, but obviously there is some amount of dumping that happens across the world, and with the hope or expectation that the U.S. elections may lead to a government that will lead to tariffs, right? What does it mean for entrepreneurs across these emerging markets? They have to deal with this challenge.
So let's start with why is it that export prices in China are falling? Export prices in China are falling because of the direction of policy support in China.
Yes.
It is not about more fiscal stimulus or more rate cuts. It's the fact that fiscal policy in China for last 2 years, since the reopening started, has been completely and totally focused on producing more things, supporting producers, and not supporting consumers. And domestic consumption has been disappointing every passing quarter. And that has created massive amount of excess capacity, along with the fact that the housing market is also going through a massive adjustment.
Sure.
With that kind of excess capacity, and if you keep on pushing on that one string that you have, which happens to be industrial production and infrastructure, you are going to create excess capacity, and that excess capacity has to be absorbed through lower prices, not just domestically. China has a serious deflation problem internally. It is also going to seep out and seep into export price disinflation. I don't think that this is quote-unquote dumping. I mean, you can use that term. It is that prices are falling in China. Internal prices are falling in China. That is being reflected in external prices. So, or that the exchange rate is depreciating, not in the last 3 months, but prior to that. So I'm not trying to excuse the fact of people are using the word dumping, but I think we need to be a bit more attentive to what is happening. It is that cost of production in China is falling because China is going through a very large internal deflation. Now, there is a question about tariffs, right? So let's say we do get Trump 2.0, as President Trump and his proxies have said, not once, many, many times, that they will impose tariffs on China to 60%. They've also talked about a 10% tariffs on everybody else. Let's set that aside. Let's look at something that they will most likely do, which is a 60% tariff on China. If you get a 60% tariff on China, the immediate impact is going to be on dollar CNY depreciating to offset that. That's nearly a 30% depreciation from the current level. Okay. 7 goes to 9. Clearly, PBOC is not going to let 7 go to 9. PBOC is going to stop it somewhere, because otherwise you're going to create a serious financial instability in China.
Yes.
Let's say they stop it at 8. I'm just throwing out numbers.
Sure,
there's no meaning to these numbers. Let's say they go halfway, they stop, they say that 8 is a line on the sand, or the market assumes that 8 is a line in the sand. That's a 15% depreciation of CNY from what it is today, which means instantly, let's take India. INR appreciates by 15% against CNY.
Oh.
We are already, talking about the massively rising trade deficit with China. Now imagine that trade deficit with CNY 15% depreciated. I'm not talking going to 30%, just 15% depreciated. What happens to that? And this is not dumping. The US imposes tariffs. China reacts as China should react by depreciating its currency. The currency depreciation 15% without any change in the pricing of that product becomes 15% cheaper in India. This is not dumping. This is just that it just becomes 15% cheaper without doing anything.
That makes you domestically not very competitive then. I mean,
of course, it doesn't make it domestically not very competitive, and that is a problem. And the problem is not being created because China is dumping. That's the point I'm trying to make.
Sure.
It is happening because the US imposes tariffs on this thing. So, just to give you a corroboration of that, we talk about the 2018-19 trade war. In the 2018-19 trade war, the exports from China to US in the tariff products fell very, very sharply. Countries like Mexico, Vietnam, India to some extent moved into offsetting that. Guess what? The share of China in global trade actually increased, even after losing massive market share in the US, because China used that depreciated currency to move into non-US markets, particularly in emerging markets, Asia and Latin America, Africa and Russia. So the point I'm trying to make is that what happens to US-China just on the tariff side has significant spillover impact on other emerging markets, including India. Something which I find shockingly absent in India. I've been in India now for 3 days. Shockingly absent in any discussion about what might happen or what is the impact of the election risk on India right now. It is almost as if, well, it's going to happen on China. That's good for us, isn't it? No, it isn't. This is a serious problem, spillover effect that will happen not just in India, in every emerging market country. Other emerging market countries like commodity exporters don't get affected that badly, but every manufacturing exporter, particularly in this region, get affected instantly with a seriously more competitive CNY.
All right. I want to wrap this up with one question around the flow within the Indian government debt.
Sure.
Last year when we met, you spoke about certain reforms will come in once you have higher participation of foreign investors.
Yeah.
Now that the flows have started coming in.
Yes.
Are you seeing that happening?
So we are seeing, somewhat of a cold feet.
Okay.
I mean,
surprisingly,
RBI and the government of India negotiates, does lots of reforms in order to get into the GBI EM index. They get into GBI EM index, and then for reasons that I'm not exactly sure, RBI as a debt manager of India decides that they are not going to let the 14-year and the 30-year maturity to any longer be counted as automatically approved for foreigners. I find the logic very hard. So you really want pension funds in the US and Europe to invest long-term in India, and the way to do it isn't by taking away long-term instruments, is it?
Yeah.
So I haven't the faintest idea why this cold feet or why this shift in strategy. Maybe they have a master plan, but it's very hard to see that master plan at this point in time.
But are they equipped to deal with the flows in case they do come in as a 10-year or 15-year?
Well, absolutely. Why not? What is there? You will do RBI. We spoke about that last time.
Yeah.
I think there will be no impact on the yield curve. There will be no impact on the FX. RBI will intervene every dollar that comes in, and it will then go into the bond market and intervene there to make sure that the yield curve remains exactly where it is. Remember, India runs a current account deficit, and RBI rightly believes that every dollar earned is a liability. It is not an asset, because there's a liability associated with every dollar that they intervene, that comes into the country. This is not a current account surplus country like China, where you are genuinely earning it overseas. We are borrowing it. And RBI today, RBI yesterday, RBI day before yesterday was fully aware of that. And RBI has always believed that every dollar it earns is a liability at the end, associated liability at the end of the day. And therefore, it is going to intervene.
All right, Jahangir, thank you so much for joining us on this conversation, sir. Pleasure talking to you. Thank you so much for watching.